Fook Hien is with us. He's senior investment strategist at Standard Chartered Bank. Fook, great to have you with us here. Thanks very much for your time. Just a word on the US CPI and its importance, Fook. You think, the hurdle for equities in the US to correct is pretty high now? The bar is very high. I mean, you got to get a really blowout number for equities to feel the pain, or you think about slightly above consensus can do it. What's your sense?
Yeah, you're right. We've got a CPI, we've got a retail sales, and then we have the PPI data coming up this week. These are very key data points that we're watching out for. Look, I think the CPI print, we don't have a view on what is it going to be tonight. But the trajectory we're looking for is for it to come down, and to the extent that we still expect that rate cuts will be coming for the rest of the year. We think that is going to be the trajectory. Look, in terms of tonight, we saw that the US market has been making a lot of new highs. The technology sector has consolidated a little bit after some earnings results came out from some companies in the semiconductor sector. So we think that is healthy for it to consolidate a little bit. But the trajectory in terms of the earnings growth and the trend over the 6 to 12 months, we remain confident that is good for technology sector and for the US sector. But the sectors like technology, which typically are growth sectors, would be very sensitive to yield and yield expectations. The narrative has been very much that as yield falls, that is supportive for the valuation of the technology companies. So there is a bit of earnings on one hand and yield as well. There's very much driving technology stocks, and technology, as you know, is a very large part of the US market. So the positioning, we flagged a few weeks ago, positioning has been very elevated and one-sided in the US. We thought there could be a bit of pullback. We think it's getting a bit better now, but there's still risk of just in terms of positioning, a bit more consolidation. But it is healthy in our view for the US market, because we do expect the earnings at the end will be actually driving the US market higher.
Fook, hi, good morning. What is your view on India now? I know in the past you've liked this market, but given the rally and given the fact that we're seeing some sort of rumblings in the broader market now, mid-caps and small-cap stocks, some correction setting in, plus we're getting into election season as well. So what's the call on this market here?
We think it makes India more attractive in terms of better entry levels. India is a very core medium-term holding for us. We think the growth trajectory is going to be very attractive. Look, I think within Asia, we saw a bit more a rotation out of Japan and perhaps out of India as well, and into China in recent days. China, of course, had a CNBC meeting, which was a bit, meeting expectations and disappointing in some areas. But overall, there's been quite supporting on the downside in terms of policies that they're going to roll out. And so I think there's been a bit more money going into China out of other regions. There's also earnings going to be coming up in China. A lot of big companies going to be starting to report next week. But for India, look, our view has always been that it's a great market, a great growth, but valuation is elevated. So if valuation comes off, we think that makes it more attractive. Our preference in India has been more for the large caps, just because there's a higher margin of safety, because the external environment outside of India is still a bit uncertain, then this could affect your investor flows. That's why it's part of the reason why we do like large caps within India for the higher margin of safety.
All right. Hi, Fook. Morning. So China downside could be limited because of the monetary and fiscal policies out there, while India, you would like to get in a little bit cheaper. That would mean that maybe, in fact, India pulls back a little bit from here. Let's see how that goes. But I wanted to ask you about the US presidential election. I believe you'll have written a note out there and, making an interesting point that Trump could be good for the United States, but Biden, if he continues as president, will be good for the rest of the globe because Trump could be disruptive. Tell us more.
Yeah, indeed. We're 8 months away from US elections. It looks almost certain we're going to have a rematch now between Trump and Biden. And Trump, in terms of his policies, we think it will be initially positive for US assets and the US dollar, and it will be disruptive for the rest of the world. Now, in terms of the exact impact, he wants to have a lot of tax cuts within the US, and at the same time, he wants to impose tariffs He wants to restrict immigration as well. These are some of the policies that he is pushing. So the exact impact on the market, I think, would depend on sequencing. Obviously, if tax cuts come first, that's going to be positive. But then if tariffs comes first, it's going to be more disruptive for the rest of the world. So the exact sequencing of the policies and the way it's rolled out will matter. But broadly, we do think that Trump will be positive initially for U.S. assets and for the US dollar. But I mean, 8 months is a long time, right, in politics. And at the moment, the indicators are that he is leading. But 8 months is a long time, as I said. If the US manages to avoid a recession this year, we think that'll be more positive for Biden, for him to get re-elected. There are 6 key swing states in the US that we are watching. And these 6 states will ultimately, we think, be crucial in determining who will be the next president.
Okay, well, Fook, we'll leave it there for now. Thank you very much for your time. Great speaking with you here on CNBC TV18. Thank you.